Sooner or later, a lot of us are going to take out a pretty big loan. For a house, maybe a business, or for education. It's a massive step, for sure. But it also brings up a really serious question, one we don't always like to think about, right? What happens if you're not around to finish paying it off? I mean, you work your whole life to build something, to leave a legacy. But what happens to that debt? Who gets stuck with it?
And that's the scary part. Without a plan, that huge loan, it doesn't just disappear. It can fall right on your family's shoulders. And suddenly that home, that asset you were so proud of, becomes a huge source of stress. But there is a financial tool that's built specifically to stop that from ever happening.
The solution is kind of like a safety net, but it's a really unique one. It's a safety net that's designed to shrink right along with your debt. Let's break down how that actually works.
It's called decreasing term assurance. Now, when you think of life insurance, you probably think of a fixed payout, right? That's the standard stuff. This is totally different. It's made just for loans. So the amount it pays out actually goes down over the years because, well, the amount you owe on your loan is also going down.
Okay, so check out this chart. It makes it super clear. See how those two bars, the loan balance and the insurance cover, they move together perfectly in sync. As you pay down your loan, the insurance coverage drops with it. The whole point is to make sure that at any moment, the policy covers exactly what's left on the loan. And here's the best part. It means you're never overpaying for insurance you don't actually need anymore.
All right, that's the theory. But what does this look like in the real world? Let's get practical and dig into a real-world example of one of these plans to see how it all fits together.
So we're going to use this plan as our case study. Now you'll see it described as non-linked, non-participating. That just sounds complicated. All it really means is that this is pure, no-frills insurance. There's no investing component, it's not tied to the stock market, it's built for one thing and one thing only, to protect your loan.
And when you look at the features, you can see just how specialized it is. See that part about no maturity benefits? That's actually a good thing here. It's by design. It keeps the cost way down because it's only there to pay out if needed. The flexibility is also a huge deal. You've got choices on how you pay, and you can even set the plan's interest rate to match your loan's rate. It's all about keeping things aligned.
When it comes to paying for this, you've basically got two ways to go. On one hand, you have the single premium. You just pay one lump sum right at the start and you're all set. Plus, you can usually surrender these policies if your plans change. Or you can go with a limited premium. With this, you pay your premiums over a shorter time, say 5 or 10 years, even if your loan is for 30. And they give you a 30-day grace period on payments, which is a nice little cushion.
So you might be wondering, is this for me? Who exactly is this kind of plan built for? Well, like any financial product, there are some pretty specific requirements, and they paint a really clear picture.
This table pretty much tells the whole story. The entry age goes up to 45, and the coverage amounts are significant, starting at 50 lakh rupees. So it's clearly aimed at people in their prime working years who are taking on those big life commitments, like a mortgage or a business loan. And with policy terms from 5 to 30 years, you can literally tailor it to match the exact length of your loan.
Okay, so we've covered the what and the why. But what about the how? How do you actually go about getting a plan like this set up to protect your own legacy?
Now here's a really important thing you need to know. Unlike pretty much everything else these days, you can't just hop online, click a few buttons, and buy this. It's just not available that way. Which, of course, leads to the next logical question. If you can't just buy it online, what do you do? Who's going to help you figure out all the options and make sure you're getting the right protection for your specific situation?
The answer is you need a person. You need to talk to a licensed professional, an insurance advisor. Because these plans are so specific and need to be tailored so carefully to your loan, they're sold through experts who can actually walk you through it all.
You know, one of the advisors from our source material, Gaurav Gautam, said this, and I think it really gets to the heart of it. This isn't just an expense, it's an investment. It's an investment in peace of mind for you, and it's an investment that ensures the assets you worked so hard for can be used for good things by your family, not just to pay off lingering debts.
So to make this really practical, what should you actually look for in an advisor? Well, you'll want to see that they're officially authorized. Check out their credentials and definitely get their official license or agency number.
The goal is to find a real professional who knows this stuff inside and out and can guide you through setting up this protection the right way. So let's just end on this one thought. That house, that business, it's probably your biggest asset, right? But if you don't have the right protection in place, it can instantly become your family's biggest financial risk. It's a heavy question, but it's one worth thinking about. Thanks for joining us.